Hello everybody and welcome to our YouTube channel. My name is Bennett Tyndall, the founder of GodelTrades.com, and we are an Elliott Wave specific options trading and market analysis team. Today is currently Monday, October 22nd, 2018. And for those of you who are unfamiliar with the Elliott Wave theory, before we get started and dive in, unlike traditional price action indicators, which are lagging and reactive in nature, Elliott Wave is the only form of technical analysis that is forward-looking and predictive and forecasting in nature. So it gives you very specific price levels to be watching for, potential reversal points, potential lows, and not only that, using Fibonacci, you can determine specific time sequences in which you can anticipate these various legs of the journey, so to speak, how long they will take. So it's fantastic for forecasting not only magnitude but duration of a movement in the market. So let's go ahead and start out by taking a look at the chart that we put out for our subscribers earlier in the year. So when we were kind of consolidating into this fourth wave at around 2,800, I believe, in the S&P 500, we were forecasting a five-wave move here to a high of 2930.61. That was our anticipated near-term high prior to seeing a pretty significant correction. And although the count has changed slightly, as you can see, we got the five-wave move as forecasted, and our high ended up being 2940.91. So we were approximately just shy of 11 points off of that prediction. Again, forecasting this around 2800 here in this fourth wave. Elliott Wave is a fantastic methodology that can be utilized for not only investment forecasting, which we do use it for, but trading. Here's a few examples. Here's a fourth wave correction for Caterpillar that we were looking for. We had a nice 144% profit trade into this fifth wave, as you can see. Here's the S&P 500 just recently into this wave 2 resistance that we were tracking on Friday, last Friday. Here's an excellent example of a 61.8% wave 2 retracement in Boeing prior to a breakout. Here's a 57-point decline in Amazon that we predicted in advance. And it even works on stocks such as Tilray, a Canadian cannabis company. We were looking for a second wave support around 121.21 prior to an attempt at a third wave breakout, which is, as you can see, C of this wave 2 correction completed right at the 121.21. So let's go ahead and without further ado dive into the charts that we're watching and tracking with our subscribers. I do apologize if I sound a bit tired. It is late at night, but I wanted to get this video out to you guys. So here's the primary interpretation, and yes, we do have the all legs of the journey, all of the motive impulse waves fully decomposed. We're simply hiding the smaller degree waves in order to give you a better overall context of what we're looking at here. So initially we were looking at this as a five-wave move as noted here, and we still have up in 1, ABC down in 2, and where things changed was this breakdown, this correction. So we were able to nail the top there at 2930, just 11 points off, but we underestimated the magnitude of the correction, at least initially. Once we got into here, it became quite clear towards the end of September that this was in fact a five-wave movement of the minor degree, at least in our opinion, completing a higher degree wave 1, which would be the intermediate degree. So post triangle thrust back on May 3rd of 2018, we had a nice five-wave move to the upside. And now we're looking at a counter trend wave 2. This is our primary interpretation at this point. Typically a wave 2 will retrace anywhere between 61.8% and 78.6% of the previous wave 1 advance, and that's represented here. So we're currently looking for one final push down. If we get off the daily, and let's get down to the 30-minute with you guys. So here's the corrective sequence following the intermediate degree wave 1 completion. Let's go ahead and hide the watch list. So we had we're trading into a flat essentially, down in A, up in B, and in a flat is a 3-3-5 corrective sequence, as opposed to a zigzag, which is a 5-3-5. And on a flat, the B wave must retrace at least 90% of the A wave decline, and in fact, in a running flat, you can actually exceed that level. Here you can see we retraced pretty much 100% of the A wave decline. We had down in A, up in B, down in C to complete A of 2. We then had another 3-wave move in B. Of this 3-wave move, B was labeled as a triangle. And from there, we had a 5-wave decline that we're tracking to complete C of wave 2. So we had down in 1, up in 2, down in 3, and if you take a look, let's get off the 30 minutes, get all the way down to the 15 minute, just to emphasize the fractal nature of the Elliott wave theory. So we can actually take this wave 3, decompose it as an impulse, and it breaks down into a nice 5-wave sequence of its own. So following that, last week we were tracking this, let's get back to the 30 minute, this 4th wave correction. And then into Friday, Thursday, when we had the breakdown, we had a nice 5-wave sequence here. This decomposes into a nice 5-wave sequence to complete this minuet degree, blue parentheses wave 1. This is the wave 2 counter trend move that we were targeting and noted here. So we were looking for resistance there before decline, and we got right between the 61.8% and 78.6% retracement. Now we're looking for a completion of this larger degree wave 5. So this larger degree wave 5 is breaking down into a nice 5-wave sequence of its own, and we're currently forecasting this wave 3 to complete sometime this week. So we'll have 3 of 5, 4 of 5, then 5 of 5, and that should finish this wave 2 correction. Now I want to note that typically a wave 2 is a 61.8% time extension of the wave 1 advance, meaning the duration of wave 1, 61.8% of that should be the time for the wave 2 correction, which introduces the possibility that we're simply tracking the 3-wave move down to complete A of the ABC correction that we're anticipating here in wave 2. Given the fact that this is so far developed as a 3-wave move, that would indicate this wave 2 is going to be a flat, which means B wave must retrace between 90% or higher of the A wave decline, and typically a B versus A time extension puts you anywhere between equality to 127.2% of the duration of A. So if we had this, if we complete A this week, we'll have a rally up in B and then a move down in C. That said, there is evidence to support the possibility that the top is in. I don't quite see it yet. I'm not ready to call it, the end of the bull market and simply just go aggressively short to the downside. We did close today below the daily 200 moving average, which is definitely of concern. And we are also, let's see if I have that chart available. We are also trading now right on top of the weekly 50 moving average. Let's switch this back to red and white so you guys get a better view of that. So that is of concern. And in addition, if I pull up my other chart here and we take a look at the SPX, you can see clear momentum divergence, okay? Following the January 26th highs that were established in the S&P 500, even following this triangle, it's just been very, very choppy and a very clear divergence of momentum. So that actually introduces a few possibilities, one of which is that the top is in and that we are entering a potential bear market. I'm not ready to put that count up just yet. The reason I say that is we do have alternate possibilities that would support continued volatility and continued sideways movement through the midterm elections. Currently, there's a lot for the market to be digesting. We have trade negotiations. I feel that the trade concerns have really yet to manifest themselves in the market and reflect themselves in the price. Typically, things like that are priced into the market in equities. But I feel investors rather have sort of shrugged off concerns there, and they're almost discounting it in hopes that the end result will be beneficial for our country. And while I am optimistic, and I do feel that the long-term end result will be beneficial to the United States, I think the road to clearly defined trade policies is going to be a choppy and extremely volatile one at best. So this count would support sideways volatility, and essentially this extends the entire fourth wave correction, as opposed to considering this a completed triangle, which this does trade out extremely well as a triangle. Generally speaking, you will find at least one point on the triangle with alternating 0.618 relationships. So for instance, a D versus B retracement here gave us 27.18.31, meaning if you were to take the advance of B, project it from the bottom of C, and look for 61.8% of that move, that would give you your D wave top. And in fact, once we had confirmation of this D wave top, we traded some SPX puts. We were picking those up for $1.80 and $2.30 on Monday and Tuesday. We were accumulating them. We ended up selling those on Wednesday on this move down to the 200 moving average for around $30, I believe, per contract. That was an epic move. We had a lot of fun taking advantage of that short. And I'm certainly looking forward to shorting further downside in the markets. So it is possible the top is in. Let's go ahead and look at what that would entail and why that could potentially be a possibility. So we're going to go all the way back to .com era year 2000 highs, and this was the wave 3 of the super cycle degree completion. We then tracked a flat in wave 4. So we had 3 down in A, 3 up in B. Our B wave retracement gave us a nice equality of B versus A. And then we had the credit crisis of 2007, which carried us all the way down here into C, which nearly gave us C versus A equality. So right between C versus A equality and a 138.2% extension. Let's go ahead and add a 127.2, exactly a 127.2% extension. Taking a look at the time extension of C versus A, it ended up being 61.8%. So then we started the next round of the bull run back in March 8th of 2009. And I'm going to go ahead and, as I said, hide these smaller degree wave sequences for you guys, just to not confuse you. So we had up in 1, ABC flat in 2, up in 3, zigzag in 4, and now we're tracking into the 5th wave of the super cycle degree. And if we bring in these waves, you can see the primary degree, wave 1 up, wave 2 down, wave 3 up, wave 4 down, wave 5 high. Generally speaking, when you have an extended third wave, and your wave 3 is the longest, net distance traveled in wave 5 is typically equal to wave 1. That puts us at 3015 spot 58, so 3015 spot 58. But as you guys know, 2940 spot 91, the all-time highs that we've established thus far in the S&P 500, that's just a stone's throw away. So let's dive into the time extension here. So generally, a 5th wave encompasses 38.2% of the entire 1 through 4 movement thus far, meaning it's going to take 38.2% of the duration that this entire sequence is taken. If we get off, zoom in here a bit and take a look at this, this is exactly what that represents. So the 38.2% 5 versus all came into play on October 7th, right as this correction was getting underway. So that brings us back to our primary count. Currently, we're looking at a potential movement like this. Once we complete wave 2, we'll have a nice wave 3 advance all the way out to as far as June 2nd of 2019 and as high as 3302 spot 34, or right at equality at 3056 spot 31. Then the corresponding 4th wave correction, then we're up in 5, then the top is in, and this will complete wave 1 of the grand super cycle, which means we're going to be under some pretty significant technical selling pressure. So once this is completed, once we have an intermediate degree 5 wave move here, that will complete the primary, the cycle, and the super cycle degree movement. Now, it is entirely possible that this 5 wave move post triangle thrust is all she wrote, and that we can switch this and label this as the intermediate degree and defer to our top is in count. And that would complete a very long market cycle. So there is evidence to suggest that the top is in. I'm not quite there yet. As I mentioned, there's a lot for the market to digest right now. We're in a rising interest rate environment. We've currently had 3 interest rate hikes from the Federal Reserve this year. We have a 4th forecasted for December of this year. Currently 12 of the 15 members are anticipating a 4th rate hike this year. Bonds are breaking a 30-year uptrend as yields are on the rise. Remember, bonds and yields are inversely correlated. And that also puts pressure on U.S. equities. And when you have passive portfolio managers, passive investors, and investment managers who are trading on a strict set of rules, oftentimes they have no choice but to rebalance their portfolios when things like this happen. So currently I'm leaning towards this is the primary count and that we still have some further upside left. This would coincide with several analysts and economists' expectations of a late 2019 or early 2020 recession, which I'll post a link with this video that sort of better illustrates and talks about our current economy, the overshoot in inflation. You know, so many analysts are really uneducated when it comes to economics and just how the economy, how this all works together. When you have, you know, record low unemployment levels, you know, you have an inflation overshoot, we're in a rising interest rate environment. Add on top of that, you know, trade concerns and these recent tariffs that we've had. Once we see the impact of the tariffs on corporate earnings, which will eventually affect retail spending, that's just a perfect storm in my opinion. There's just a lot going on and a lot for the markets to digest, so it's absolutely possible, guys, that this is in fact the top. So that's the S&P 500. Let's go ahead and jump over to the Nasdaq and let's take a look at our primary count here. So very similar situation as with the S&P 500, although I'm not labeling this as a triangle for the 4th wave. I'm simply labeling this as a flat correction, given the fact that the sequence of the impulse that follows lines up so closely to your typical and expected Fibonacci projections. In fact, we can get down to the 30-minute, and although let's get down to the 1 hour. Although this could be counted quite well as a 3-wave move, this also decomposes quite well as a leading diagonal. Looks like I already have that decomposed. Okay, so I am currently decompose leading diagonal. There we go. One thing I really like about the Motive Wave software is the fact that it lets you know when you violate a rule of the Elliott Wave theory, and so you know in real time whether or not your count is valid from a rule standpoint. Now remember, for anybody who's considering getting into the Elliott Wave theory, there are always going to be multiple valid counts from a rule standpoint. It's important that you compare the guidelines of the Elliott Wave theory to your account, and you also do a broader market analysis to determine perhaps whether or not your count is in fact valid. But generally speaking, I'm not going to get too far into this, but generally a wave 2 retraces between 61.8% and 78.6% of the wave 1 advance, and that's what we have right here, right down to the 78.6%. A wave 3 is typically a 1.618 or 161.8% of the distance traveled in wave 1, meaning if you were to take a Fibonacci extension tool and measure the distance of wave 1, project it from the bottom of wave 2, that would typically give you your wave 3 target. And as you can see, guys, that came right into play there for our minor degree wave 3. A wave 4 is generally a 38.2% retracement of the previous wave 3 advance and or demonstrates equality to wave 4. Here would be equality, and right there is your 38.2% retracement. We then had an ending diagonal in this 5th wave to complete intermediate degree wave 1. So we're tracking into a wave 2 correction here, down in A, up in B, down in C, very similar to the S&P 500. So again, there is evidence to suggest that this is in fact the top. And let's go ahead and take a look at the time extensions that we have lined up for you guys here on the Nasdaq. Just to give you an idea of how well the market respects these Fibonacci time extensions. Generally speaking, a wave 3 is not only equal in magnitude of a 1.618 or 161.8% of wave 1, but it also, from a time extension standpoint, is as well. So duration of wave 1, which took place from November of 2018 all the way to 2008 all the way to April of 2011. If you were to take the time here, project it from the bottom of 2, look for 161.8% for the top of wave 3, that would give us July 14th. We completed wave 3 on July 21st before entering a fourth wave triangle. So absolutely remarkable how well the market respected this time extension for wave 3. Now let's take a look at our fifth wave time extensions. So our fifth wave time extension supports 5v1 out to December 1st, 5v3 out to December 11th, and 5 versus all to May 21st of next year. So the Nasdaq does, from a time extension standpoint, support further upside from here, which also factors into our primary count here, which we're looking for a very similar movement as we are with the S&P to complete the cycle before calling the top is in. And this is forecasting to September, November of next year, right out, on pace with the S&P 500. Okay. Another guideline and another way that you can forecast your fifth wave high is to take a Elliott Wave channel. And essentially you take a channel line from the top of 1, you go over the top of 3, you project a parallel channel to the bottoms of 2 and 4, and that typically gives you your fifth wave target. Now we can't go from 1 straight over the top of these January highs, as that would violate 2 and 4. And in fact, we were letting our subscribers know that this move back in January of this year, this January effect bull run that we had, we were just walking ourselves right into a correction. Another rule of thumb that we discussed with the S&P 500 is typically when you have an extended third, net distance traveled in wave 5 is equal to wave 1. So 5v1 equality is right here at 73.22.40. And if we get back down to the daily, take a look at this. That would be right here. And as you can see, price action got extremely choppy over that price level. In fact, in this B wave retracement, that is exactly where we ran into resistance. We had a high on this B wave retrace of 73.11.85, and this is 73.22.40. Also, looking at this Elliott Wave trend channel in blue, look at the interaction, the price action, how it interacted with that trend line along the way up here. Okay, some very, very bearish indications, more questions than answers. It's really just a waiting game to see how all of this materializes. If we get a break below these fourth wave lows on both the S&P 500, let's do this, on both the S&P 500 and the Nasdaq, that would absolutely be confirmation, in my opinion, that the top is in. Yes, we still have this triangle count, which could support a move lower as long as we don't break below this low here of 2532.69. We could get down and hang out around this 2600 area, but I favor this count. So if we break below this wave 4 low here, which is currently 2594.62, which is also this 100% line, which is essentially the start of the wave 1 advance, that would be of concern for me. Then you could potentially consider this the end of the cycle, and we're entering a pretty significant correction. Okay, so keep that in mind, guys. I hope that helps with the indexes. Let's see, the Russell 2000, where's my primary count? So my primary count for the Russell 2000, very similar. to the Nasdaq 100 in that this wave 2 is actually giving us a full 78.6% retracement. And again, this is 2 or simply A of 2, given the very short nature of the duration thus far of wave 2. Here we had a flat for fourth wave here, up in 1, down in 2, up in 3. Check this out, another 161.8%, 3 versus 1 extension, and a 61.8% retracement there. Wave 4 gave us equality of 2 down in the A leg of the triangle, and also gave us a 38.2% for V3 retracement. Then we had a nice 5-wave move to complete 5 to make up 1, and then we're down in 2. Notice this started pushing lower back on September 3rd, where if we look at the S&P, we were moving up through September, and that's pretty common, actually. Believe it or not, you do often find that small caps will lead the markets. Okay, so I find it important to keep yourself apprised of the Russell as well as the S&P 500 and the Nasdaq 100. I do not track the Nasdaq composite simply because of the fact that the majority of traders are tracking the Nasdaq 100. That's what moves the markets. Those are the top 100 technology stocks, and a few others are in there as well. But that's really where the breadth of the market is, when it comes to the Nasdaq at least. The Dow Jones, you know, I don't necessarily track this very often. I don't find it's really productive to be tracking a cap-weighted 30 stock index. I do have a count put together for it, but just don't follow it as often. I just really don't. We focus on the S&P 500 and the Nasdaq. Those are our two primary indexes that we count and utilize in our analysis when trading options at Godel Trades. So, for instance, let's look at Google. Okay, here's our primary count for Google. Very similar to the Nasdaq 100. Okay, ABC flat in wave 4. Up in 1, down in 2 to the 61.8 to 78.6% retracement to shake out the longs. Then we had a nice 5-wave move in 3, right to the 161.8% extension. Wave 4 gave us just between a 38.2% typical retracement and 4v2 equality. So waves, corrections of the same degree, you'll at least find 2 that will tend towards equality in both magnitude and duration. Then we had a combination correction here in wave 2, and remember what we were just discussing with the fact that the Nasdaq and the S&P and the Russell 2000, the wave 2 that we're tracking, the time extension is very short. If this is all of wave 2, it's unusual. It's certainly unusual. It would definitely be a very swift and to the point wave 2 correction. Again, wave 2's that 61.8 to 78.6% retracement target. This is exactly what we had for Google, a nice 61.8%, and also right to the anticipated 61.8% 2 versus 1 time extension. So this gives us a nice proportional look, and this meets the guidelines of what's referred to as the right look in the Elliott Wave theory. So in the Elliott Wave theory, you wouldn't have something like, you know, like this, really small wave 4, huge wave 2. That's not very common. That doesn't play out very often. But the same question stands for Google as does the Nasdaq. If in fact this sequence, if we can label this as the intermediate degree and call this the top, it's going to be really interesting. Things are going to get quite interesting. Amazon, I'm currently bearish on Amazon going into earnings. We've been tracking a wave 3 completion. I do have a potentially bullish interpretation, but I just don't see it currently. This has been trading out extremely well, and just to get into the fractal nature once again of Elliott Wave, here's the minor degree wave 3. Inside of that, you have a 5-wave sequence. Inside of 3, you have a 5-wave sequence. Inside of a third of the third, you have a nice 5-wave sequence, which is very indicative of the magnitude of a wave 3 decline. So again, a nice down in 1, up in 2, right to that 61.8% extension. All right, guys, that's about it for the technicals. Let's go ahead and take a look at sector performance and sector health. Let me bring up my chart from Thinkorswim. All right, so a lot of people don't understand this, but the sector spiders are unequally weighted, okay? The weighting here is very skewed. For instance, the consumer discretionary ETF XLY, I believe, is around 20 to 25% Amazon, okay? So we've been on a nice bullish advance. Now, technology, consumer discretionary, and financial, those are typically 3 sectors that make up a bull market. Consumer discretionary on an unequal weighted basis has made a pretty significant high beyond the January extension. If we take a look at the equal weighted consumer discretionary, so consumer discretionary is on an equal weighted basis, we have not broken the January highs. We got really close here back on the 21st of September, but we were unable to break it. Let's see, let's take a look at technology. So technology on an unequal weighted basis, nice break to the upside. We did get a new high on an equal weighted and an unequal weighted basis, but I find it's important and it helps to absolutely compare the equal to the unequal weighted sectors. Bonds, again, breaking significant uptrends. Here we have the 10-year breaking down as yields are on the rise. We have the 30-year breaking down. And what was interesting is previously, if you were to look at this on a log scale or a semi-log scale, it was breaking the trends, and it's been under pressure, and this is absolutely having an impact on the U.S. equities market. So that's about it, guys. I just wanted to kind of briefly discuss that. Let's see, healthcare. Let's get back to the 1-year daily chart. Healthcare has been looking good. Healthcare did make a new high. Utilities have been breaking down. Let's see here. They're holding up actually fairly well, but they're starting to initiate a potentially corrective pattern. If we get back to the S&P 500 to look at that momentum divergence, we get off the daily and get off to the weekly chart. You can see we're right on top of that 50 moving average, very key line in the sand. But currently the area that I'm watching is the 2594 level for the S&P 500. We are expecting, and we did forecast, additional downside in the markets this week. So we will be tracking that one closely. But there's absolutely a lot to be concerned about currently in the markets, guys. It's absolutely possible that the top is in, and once we have confirmation that the top is in, we will be aggressively going short on this market. So I hope that helps. I hope that gives you a bit of an introduction to the Elliott Wave theory and what we're looking for in ways that you can absolutely give yourself an advantage in this marketplace. We find it's a fantastic form of analysis which helps you better manage your emotions in trading. And again, unlike traditional price action indicators, which are lagging and require price action to react, Elliott Wave is forecasting and predictive. And in fact, let's take a look at something really quick. I'll bring this up before I move on to my next and final topic. So here's a fantastic example. Taking a look at AMD. We were forecasting this wave 4 38.2% retracement at 24.64. And we had a trade last week where we held calls overnight for 70% with a max 100% profit overnight out of this wave 4 correction. If we were to dive down into a smaller time frame, you could count a completed corrective structure here. So up in 1, down in 2, up in 3, down in 4, and breakout in wave 5. This trend channel here actually represents a very very long multi-year channel from 2000 to 2015. We were in this corrective structure, and we did run into resistance right up in there. We got just over it, so it is possible that if the markets pick up the pace and we get a nice wave 5 here, we could potentially have truncation, and that we don't break the wave 3 highs. We'll have to wait and see. Once this wave 2 correction completed earlier in the year, we put on a longer term equities hold. When we broke 13, I identified a wave count that suggested a near term target of 21 in AMD, and you can take a look at our website and go to the news section and check the date on that one. Had a lot of fun trading this breakout. Many people were skeptical of the potential there, but it ended up working out really well. But as you can see, this wave 4 correction, we had a nice, call option, 70 to 100% profit potential overnight, holding a position out of this completed corrective structure. We'll take a look at the MACD and where it was. It had yet to curl up. We didn't have the potentially bullish convergence and then bullish divergence. If we would have waited on that, we would have been somewhere up in here back towards the B wave highs. So without the context that the Elliott Wave system provides, you're unable to really determine these very key levels in the market. Boeing, we had a lot of fun with Boeing. Here's a fantastic example. This stock was in a corrective fourth wave triangle from February 28th of 2018 all the way to August 15th of this year. And if you look at this chart here, just on a traditional indicator, there we go. So if you look at this, what other form of analysis would be able to tell you that after this entire range and this bearish momentum divergence that you were going to get a very significant breakout? Not many forms of analysis can do that, which is why we love the Elliott Wave theory. And another reason we love the Elliott Wave theory and use it as a trading methodology is the fact that it gives you very specific areas to know when you're right and to know when your trade is wrong, and it gives you very key stop loss levels of when you can cut your trade. Not only that, it's a system that everybody can learn to understand and interpret and utilize to their advantage. Far too many traders, in my opinion, are very egotistical, and they utilize basic indicators, and they'll make a call and it'll work out, and they'll say, hey, look what I can do, look how great I am. Well, that takes all of this away. With Elliott Wave, it's a strict system. It is sort of an art form with guidelines and rules. But if you can learn to understand it, if you can learn to interpret it and apply it, if it works out, it's not you, it's the system. And I love that about the Elliott Wave theory. So we did have an excellent trade. I forget, but it was in excess of 150% trading this into wave 3 out of this wave 2. Again, wave 2 right to 61.8%. Wave 4, 4v2 equality. It's really quite incredible. Now, one thing to point out on Boeing before you guys go buy long positions for this wave 3 here, oftentimes when you have a very prolonged fourth wave triangle correction like this, the fifth wave here will only be equal to the widest portion of the triangle, okay? And so using our fib ratio tool, we simply measured the widest part of the triangle, which was wave 5 down to A, and projected it from the completion of the fourth wave triangle. That told us to expect 392.22. Thus far, the highs here were 394.28. We are holding the 61.8% 2 versus 1 retracement level, so it is quite possible that this count is still valid, but given the fact that we backed off right at that 392.22 level, which happens to be the widest portion of the triangle, I am putting this potentially alternate interpretation and count up, and that this was simply of the intermediate degree and primary wave 5 is complete, and we're getting ready to go to work on the downside. So this is one you gotta wait and see. Okay, gotta wait and see. Whoops, I want to bring that back. So just to recap, S&P 500 absolutely looking for another push to the downside to complete C of 2 or A of 2, at which point we should have a relief rally moving back up later in the week. We do have some extremely key earnings on deck this week. AMD, Microsoft, Visa, AT&T, UPS, McDonald's, Caterpillar tomorrow morning, Alphabet, so Google, Shopify, Snap, General Electric, Amazon. It's going to be a pretty incredible week, and it should be very telling as far as where the indexes want to take us for the next 1 to 2 months, or even 3 months or beyond. So we're gonna have to wait and see. I want to bring one last piece up for you guys before I sign out of here. So here are the market, the 4 major indexes. Okay, the Nasdaq 100, the Russell 2000, the Dow Jones, and the S&P 500. Look at the divergence between the Russell, the Dow, the S&P, and the Nasdaq 100. We're looking at this on a percentage change basis dating back to 2010. So these 3 indexes have been in line with one another, very correlated in their movements. Nasdaq 100 has been on an extremely significant uptrend with a pretty significant divergence between these indexes. This is very similar to what we saw in the year 2000 when we had the kind of dot-com era year 2000 high bubble. So it's something to keep on watch. Another thing that I want to point out, let's take a look at this here. This is taking a look at the S&P 500 versus VEU. Now, why did it do that to me? There we go. So this is VEU versus the S&P 500. And again, on a percent change basis. You can see here the S&P 500 and VEU. Now, yes, this is U.S. currency denominated, and to give you an idea of the breakdown of it, 20.3% emerging markets, which emerging markets have been extremely under pressure recently, 43.10% Europe, 30% Pacific, 0.4% Middle East, 5.9% North America, 0.3% other. So you can see the correlation, okay, in the movements, and it even respected the breakdown that we had in January. But now look at this divergence that we've had following that. Very, very interesting and very, very telling. Speaking of emerging market weakness, before I let you guys go, take a look at VE or EEM here, okay, emerging markets. So I am tracking this as potentially a wave 4. In fact, might even be more appropriate to assign this to the primary degree, but then I can't really get a nice 5-wave move out of it. Invalidation would be at 38.31. We are holding that level, but look at this downtrend channel that we've been in, holding resistance at the top of the channel. We are holding support off the bottom of the channel. Wave count and validation would be a break under those levels, and we are starting to hold that and move up just a bit. But certainly under some pretty significant pressure, and definitely something that should be on your radar, and something that is certainly contributing to the weakness in U.S. equities. So that's about it, guys. We'll leave it there. Hope you enjoyed the session. Feel free to visit our website at godeltrades.com, GODELTRADES.com. And hope to see you guys on the next one. If you have any questions, comments, or concerns, feel free to email me directly at spxdoctor@gmail.com. And if you're interested also in learning more about the Elliott Wave theory, although our team does in fact kind of give you weekly educational videos on the Elliott Wave theory. We go over charts every weekend on the setups that we're looking for the next week. CNBC's Todd Gordon also runs a service, a fantastic Elliott Wave practitioner who incorporates options trading with his wave counts. And in fact, he is he's responsible for my love of the Elliott Wave theory. So anyways, guys, I hope you've enjoyed the video. I look forward to seeing what the rest of the week brings, and I'll catch you on the next one. Take care. Cheers.